One of the most stressful aspects of being an investor is all the noise that we're constantly exposed to. Whenever the markets are down, you'll hear the news and media freaking out and see bold headlines that instills fear and panic. When we don't know a lot about something, we often turn to the people that we believe should have all the answers, like the news and the media. But when we begin to learn about investing and what is completely normal, it becomes easy to see that the media isn't playing the same game that we are. They're not looking to be successful long-term investors. They're looking to sell headlines, drive online ad revenue, and make money in the short term. Morgan Housel highlights the importance of playing your own game by saying, "A takeaway here is that few things matter more with money than understanding your own time horizon and not being persuaded by the actions and behaviors of people playing different games than you are." If we can identify when someone is freaking out about a completely normal thing, like the market being down, we have to question the game that they are playing and their expertise in what they're talking about. You'll soon realize that most sources of information don't have your best interests at heart, and you'll be empowered to quickly change whose opinion you take into consideration. That's our focus for this lesson, to understand what's normal behavior for the stock market when it comes to risk, volatility, and all the negative things that seem to come along with it. Let's start by taking a look at the bond market. Over the past 44 years, we've only had a negative return in 4 years. The worst of them, which was historically the worst year ever for bonds, was 2022. It was such a bad year that it's really an anomaly. We can see from the chart that returns are fairly consistently in a positive range up to 10%, especially with positive returns over the past 20 years. This information supports what we've talked about in the previous lesson, that bonds are less risky, have less reward, and overall add some stability, except in 2022, to our investment portfolios. When we look at stocks, we see a different story. This chart shows the annual returns for the S&P 500, which would be considered a 100% stock portfolio, over the same period of time. As you can see, the range of outcomes is quite vast, and the data looks random and unpredictable. A chart like this highlights the risk and volatility that a heavy stock portfolio can have, but it also shows significantly higher returns than the 100% bond portfolio. Again, supporting the information from the previous lesson covering historical returns. We know that annual returns don't simply move in a straight line. The annual return simply measures the difference from the beginning of the year to the end of the year. This next chart adds the maximum drawdown in each year, represented by a red dot. We can see that every year, regardless of the annual return, experiences a drawdown. Historically, about 65% of years experience a drop of at least 10%, and about 25% of years experience a drop of at least 20%. This means that over a 5-year period, we can historically expect to have 3 years where the market has dropped at least 10% within a calendar year, and 1 year where there was a drop of at least 20%, odds that are a lot higher than most people realize. We can see a lot of years where we saw huge drawdowns, only to end the year with a positive return, like in 1987, 1998, 2003, 2009, 2010, 2011, and most recently, 2020. 2009 was an incredibly volatile year, where the year continued the decline started in 2008 to end up almost 30% down, but then rallied hard to end the year almost 30% up. An incredible total move of nearly 60%. Talk about a roller coaster of a year. In 2020, the S&P 500 dropped about 34% in just over a month, with some of the biggest daily drops ever recorded. It was an incredibly uncertain time, and that was definitely reflected in the market. But thanks to quick action and government funding, the market recovered to a well above average annual return. The thing that's important to highlight here is that it's completely normal for markets to have big and even dramatic swings. The largest single day percentage drop happened in 1987, when the S&P 500 dropped just over 20% in a single day. During the 2020 crash, we saw daily drops of about 7.5%, 9.5%, and 12%, which represents numbers 19, 6, and 3 of the largest daily drops in the S&P 500's history. And the good news is that in every case of a big daily or annual drop, we're still here. We survived, the stock market survived, and not only did it survive, but in every case throughout history, it has gone on to set higher and higher all-time highs. The market doesn't only survive, it thrives. This next chart I made to highlight the fact that even if we view stock market returns as being random, the odds for success are still heavily in our favor. It plots 95 points of data comparing a single year and its next year's return, and the results are pretty neat. Even without diving into the data and numbers, we can see a couple of insightful observations. We have far more positive first years than negative first years, more points on the right than on the left. And we have far more positive second years than negative second years, more points on the top than on the bottom. Historically, looking at the data from 1928 to 2023, we have a positive first year 68.4% of the time, which is actually the exact same odds of a positive second year, regardless of the first year. Additionally, if a given year is negative, the following year is positive 73.3% of the time, which is slightly higher than the chance of a positive situation occurring at 66.1% of the time. In every case, no matter if we look at a given year as a first year or second year, the chance of it being a positive year is much greater than the chance of it being a negative year, showing that no matter what's going on in the markets, it's always a great time to be an investor. When we're able to understand what has been completely normal, it can give us a better understanding of what could be completely normal moving forward. This can allow us to not be surprised when those completely normal things do happen, and question the opinion of those who panic over normal things. The S&P 500 can make news headlines for daily movements of negative 1 or 2%. But if we look back historically, this is completely normal. In fact, the market would have to drop 20% or more in a single day to be outside of the range of what has happened in the past. Anything up to that point has been something that the market and the world has been through before, survived, and continued to thrive.